Hey everyone, welcome back for another deep dive. Today we're looking at the Chinese stock market. And to guide our deep dive today, we have an analysis from BuyStocks.ai titled Best Chinese Stocks to Invest in 2025. I mean, China, it's the world's second largest economy. They're a massive manufacturing powerhouse. So let's dive right in. First up is Baidu. A lot of people call them the Google of China, but they're really doing a lot more than just search these days.
Yeah, you could say they're reinventing themselves. It's pretty impressive, actually. That shift from being mainly a search engine to like a leader in AI, autonomous driving, cloud computing, that's a big leap.
And they seem to be doing pretty well with it too. I mean, the
Yeah.
report says that even though they had some, challenges in 2024, their AI revenue is like projected to really take off in the next few years.
Yeah, they're getting big on AI.
And speaking of bets, the report also points out that their current valuation might make them a pretty good buy.
Hmm.
They talk about something called enterprise value, which, if I'm understanding correctly, it's basically like the total value of the company, right?
Yeah, that's the basic idea. It takes into account not just their stock price, but also things like debt and cash reserves.
Right. And for Baidu, their enterprise value is only 1.3 times their revenue.
Okay.
So that seems pretty low. Doesn't that suggest that maybe the market's undervaluing them?
Well, a low enterprise value to revenue ratio can definitely be a sign that a company's undervalued.
Next on the list, we've got Tencent Holdings. And of course, we all know them as the company behind WeChat, which is like the everything app in China.
You're telling me messaging, payments, social media, it's unbelievable how integrated it is into people's lives.
Yeah, it's mind-boggling. But Tencent's actually more than just WeChat. They've got their hands in a lot of different pies.
Oh, yeah, a ton. Gaming, fintech, they've got investments in all sorts of promising startups. They're not afraid to diversify, that's for sure.
Which is a good thing.
Diversification can help mitigate risk. And speaking of risk, the report mentions that Tencent is currently trading at a 41% discount from their fair value.
Okay, hold on. Now, what exactly does fair value mean in this context?
Fair value is essentially what analysts believe a company is truly worth, based on their earnings, their assets, their growth potential, all those factors.
So if a stock is trading at a discount to its fair value, that means it could be a buying opportunity.
It could be, yeah. It suggests the market might be underestimating the company's true potential.
Got it. Okay, well, we can't talk about Chinese stocks without mentioning Alibaba. They've had some ups and downs lately, but they're still a giant in e-commerce, right?
Absolutely. Alibaba's still a major force, no doubt about that. But they've definitely faced some headwinds. Competition from companies like Shein has been heating up, and that's put some pressure on their core business.
Yeah, I've heard about that. So how are they adapting to this increased competition?
Well, it seems like they're doubling down on what they do best, which is e-commerce, but they're also really focusing on their cloud computing business, which has been growing like crazy.
And one thing that's impressive about Alibaba is that they're still consistently profitable. I mean, considering the challenges they've faced, that's got to count for something.
It definitely does. And the report even predicts an earnings rebound for them, which could boost investor confidence. Plus, they offer a decent dividend yield of 2.5%, which is always a plus for income-seeking investors.
Dividends are always nice. Okay, so next up, we've got a company that might be a little less familiar to some people, Kifu Technology. They're kind of a niche player focusing on a specific segment of China's financial market.
Right, Kifu specializes in providing credit services to underserved rural communities in China. It's a big market with a lot of potential, and they're doing it very profitably.
Okay, now that's interesting. So they're targeting a market that's often overlooked by traditional financial institutions.
Exactly. And one of their key strengths is their use of AI-powered credit assessment tools.
So they're using technology to reach customers and assess risk in a way that traditional lenders might not be able to.
Precisely. It gives them a competitive edge. And what really caught my eye was their low forward PE ratio, which is just 6.
Now remind me, what's the PE ratio again?
It stands for price to earnings ratio. It basically compares a company's current stock price to its earnings per share.
Right, right. So a low PE ratio often suggests that the stock is undervalued.
It can, yeah. It means investors are paying a relatively low price for each dollar of earnings.
So Kifu might be one to watch for investors who are looking for value plays. Okay, last but not least, we have Trip.com Group. Now, they're a company that's benefiting from the global travel recovery, right?
Big time. Trip.com is the leading online travel agency in Asia, and with travel demand bouncing back, especially in China, they're in a great position. The report mentions their stock has already seen some impressive gains, like a 97.3% return in the past year alone.
Wow, that's amazing. It really shows how powerful a recovering market can be. And speaking of diversification, the report also suggests another way to approach investing in China: ETFs and sector funds. Can you explain what those are and why they might be a good option for some investors?
Sure. Exchange-traded funds, or ETFs, are basically like baskets of stocks that track a specific index, sector, or investment theme. So instead of buying individual stocks, you're buying a share of that whole basket.
Okay, that makes sense. So you're spreading your risk across a wider range of companies.
Exactly. It's a way to get diversified exposure without having to pick and choose individual stocks. And the report highlights a couple of popular ETFs that focus on Chinese stocks. The MSCI China ETF, for instance, tracks a broad range of large and mid-cap Chinese companies.
So you get a slice of the overall market with that one.
Right. And then there's the CSI 300 Index ETF, which focuses specifically on the 300 largest and most liquid stocks listed on the Shanghai and Shenzhen stock exchanges.
Okay, so that one's a bit more targeted, focusing on the heavy hitters.
You got it. So ETFs can be a good option for investors who want exposure to the Chinese market, but maybe don't have the time or expertise to research individual stocks.
That's definitely something to consider. What are some of the overarching factors that investors need to consider when looking at the Chinese market as a whole?
Well, one of the most important things to keep in mind is that China's economic landscape is constantly evolving. It's a dynamic environment, and there are always new challenges and opportunities emerging.
Right, so it's not a set it and forget it kind of market. You really need to stay informed to be ready to adapt.
Exactly. And one thing that's really shaping the landscape right now is the government's push for economic growth.
The report mentioned some pretty significant economic stimulus measures planned for 2025. Things like tax cuts and infrastructure investments. It sounds like they're really trying to boost certain sectors.
Yeah, they're definitely putting their money where their mouth is, and those investments are likely to benefit key sectors like technology, consumer goods, and of course, travel.
So for investors, that's got to be a good sign, right? I mean, government support can really help drive growth.
It can definitely be a catalyst, but, there's always another side to the coin. And the report doesn't shy away from highlighting some of the risks associated with investing in Chinese stocks.
Yeah, risk is always part of the equation.
Yeah.
What are some of the key things that investors should be aware of?
Well, regulatory risk is a big one. China's government has a history of intervening in certain industries, particularly tech and education.
Right, those sudden policy shifts can really throw things off balance.
Exactly. They create uncertainty and can impact company valuations, so investors need to do their homework and be prepared for the unexpected.
So it's not just about picking the right companies, it's also about understanding the political and economic context they're operating in.
Precisely. And speaking of context, we can't ignore the geopolitical tensions between China and the U.S. Those ongoing trade disputes definitely pose some risks.
Yeah, those have been a recurring theme for a while now. How might that impact investors specifically?
Well, it can create volatility in the market, and it can be particularly challenging for companies that are listed on both Chinese and U.S. stock exchanges, those dual-listed ADRs we talked about earlier.
Right.
They could face some headwinds if those tensions escalate.
So diversification is key.
Absolutely. Diversification is always a good idea, but it's especially important when you're dealing with a market as complex as China.
And to our listeners, thank you for joining us on this journey. We hope you found it informative and insightful.